Hey, what's up, everybody? Today is Monday, March 2nd, 2015. First trading day in March, brand new month, clean slate, and a fresh start. Always a good way to start off the week with a clean slate. And some important things that have happened here on the broader ES larger picture. So we'll talk about that, and then I want to get into a couple of things relating to trail stops, and I want to pull up a few examples from today to run through. So you can see on the ES chart in front of you, I got the daily chart and the large retracement. Actually, I should zoom out all the way with a weekly chart, all the way back here from back in 2014, September of 2014, to highs of September. I'm sorry, October of 2013, ending at September of 2014, giving us the retracement that we kind of made that large V back at end of last year, I suppose, October of last year. That gave us that 1825s up to 2100s, and we finally hit that target, the negative 23% target. We came up close to it right at the end of 2014, but we didn't quite hit it. So nice to finally see that target close. Now, do I think we're going to come all the way halfway back here, back down to 1960s? No, no, I don't. That would essentially be back down here, making a quadruple bottom. If we kind of forecast out or look into the future here towards the hard right edge, I have a target for a first target up at 2150s, and what I think will happen here, or is a likely scenario, is if we trade up to this 2150, maybe up to 2180s, we'll end up going into an extension from highs. Oops, let me grab there. From highs to highs, that would end up lining up the pullback of the extension. Let's say the highs take us up to 2200. The pullback would end up lining up with this 2100, the prior highs. So, just another case where this resistance level hitting our head a bunch of times will then turn around and act as support. So what we're in right now, kind of this sideways, little bit of a pullback consolidation, is really healthy, because you see we have 1, 2, 3, 4, 5, 6, 7 days above, and then 1, 2, 3, 4 just below, and that gives us a nice kind of a cementing in this 2100 level and gives us a support level. So we can draw a very hard line in the sand with a stop below 2150 and a either buy stop or a sell stop. If you're long, putting a stop to close the position below 2150s. If you're not in a position and you want to get long on a breakout, putting a buy stop above 2117.75s or 2118s for a new entry. You have a very hard line in the sand, and I always like those kind of rigid, very clear failure points. So if we were to break 2100s, then I would look for us to come back down here to these highs back at 2060s. But I think we got a little bit more upside in us. If we draw the most recent retracement, we pull back nicely, and that has a little target above us at 2125. So I think, with the trading that we've seen this week so far, lower volatility, I would look for this little bit of a uptrend to continue in the short term with a pullback or some consolidation, continued consolidation around this 2100 level, and then for more upside to continue from here. If we go to the SPY, we can see that volume a little bit lower here in the consolidation, which is fine. I don't see anything incredibly is anything that stands out really right here in the last week or two. So if I go to a smaller chart, and I'm just going to turn off the overnight session just so we have a little bit cleaner chart. You can see that 2100 below us, that has a target up at 2125s. But if you look at today's price action, and I'm going to pull from this morning, from the trading hours only low to highs, and it was a little bit later in the day, but we did get a setup at 11:20, a larger larger retracement rather at the 1120. And one thing I want to talk about is, we get into these trades, and however you're entering, whether you're using the 50% retracement, whether you're using a little breakout or bracketing a candle, or whether you're just buying at support and resistance or buying at value high or value area low. Once you get in the trade, it's important to manage the trade in a way that doesn't cause you to micromanage it in a subjective way. And you want to be objective. And when you get in the trade, a lot of times some of that objectivity can kind of go out the window. So what I like to do, and I've talked about this a number of times, but just to kind of reiterate the fact that setting a target at the onset of the trade, and especially with day trading, I think it's really important to go out and use hard numbers. So if you say, okay, I'm gonna target 3 to 1 reward to risk, and you're using that 6-tick stop, then on the on the ES for this example here, using an 18-tick target and setting that target in place at the onset of the trade at the same time that you would set your stop in place. So, getting long at 2107.75s with a stop 6 ticks below, and then the target 18 ticks away from there, and kind of sitting back and letting the market work. We don't want to have the market go 2 ticks in our favor and then move our stop to break even, and then you get taken out of the trade, and then the trade ends up going in your way. And you'll notice that, okay, the market came down and hit our, filled the entry and dipped a few ticks in, but for the most part, just kind of hovered around our entry and went, a point or so in our favor and pulled back a little bit once again. But you can see, so I've got a 5-minute chart here, and we've got 1, 2, 3, 4, 5, 6, roughly 30 minutes of price action that's kind of just chopping around at our entry, and that's a long time, but I think it's important to be patient, be the most patient at the entry. And yes, it's important to cut your losses quickly, and typically what would happen is either the trade would come down and fill you, and then you would get stopped out immediately if it just blew right through that level, or comes down and fills you, and buyers start to come in, we start to gain a little momentum, and that process takes time. So it's important to be patient with your trade. And a trade like this, okay, it's hovering right around your entry. It's leaving your stop alone, leaving your target out, up at the initial point at plus 18 if you're using a 3 to 1 reward to risk, and then from there, tightening your stop as the trade goes in your favor is completely okay. You don't want to get to plus 15 or plus 16, then have the stock turn around or the trade turn around and go all the way back to minus 6 and stop you out for a loser. At the same time, you don't want to go have the trade go plus 4 or move the stop to break even, or plus 1 and say, oh hey, I made money on the trade, but in that case then you were risking 6 and you made 1, so your reward to risk over the long term just isn't sustainable. So what I like to do is trail my stop at the same time that I have my target. So you can just ditch a target and just trail your stop. But I found, especially with ES, that we get so much of this backing and filling that a lot of times the market will come up and come close to our target, or hit our target, and then reverse temporarily before before going higher. So using a target in conjunction with a trail stop is super helpful. So what I like to do is just I place my stop at minus 6 on entry, and as the trade starts to go in my favor, so getting in here at the 1120 candle, and initial stop of minus 6, the next candle just kind of do nothing. I got my bracket order out, but the next candle here, we broke this little candle. We broke out of its highs. I'll zoom in a little bit more here. So what we're trying to do is, as the trade goes in our favor, as we break out of highs from the previous candle, we can start to tighten our stop. So whether you wait till the trade starts to go, either wait till the trade comes to the opposing short to start moving your stop up, or whether you're a little more aggressive and want to do it right away, we can take our stop from the original entry, the original -6, and move it up underneath this candle. And then once we break out of highs of that candle, which the next candle did not, neither did the next or the next, but over here at 1150, we broke out of highs of the previous candle, and we can move our stop up underneath that candle. And we can continue to do that up until we get taken out. And with the regular candlestick charts, there can be a little bit of back and forth. One thing that I've been liking is to use the Heikin Ashi as a trailing stop method. So I haven't I've used Heikin Ashi candlesticks for a long time, but I haven't really used them for trailing my stop. And if you were to use it this way, use your trail stop on a Heikin Ashi candlestick, and you get into the trade, and then here's this candle breaks above the high of the previous one. So you could move your stop up here to one tick below, and then the 1140 came down, kind of double bottomed. And then as we make a new high, that 1150 candle makes a new high, and then 1155 makes a new high. But because we're using the Heikin Ashi candlestick chart to trail our stop would stay underneath the 1155 candle because we don't break out to a new high until over here at 1230. And then again 1235, and so on and so forth, and we would end up being taken out all the way here at 105, or essentially 110, because the next candle takes us down below that. But if you notice, we would have, if you're trailing your stop without a target, you'd be taken out. If you're trailing your stop with a target, the trade goes to +18 before it gets taken out of before you get your stop hit. So kind of using those in conjunction with each other is kind of the point that I wanted to make today. And I just wanted to throw out there that, with the Heikin Ashi chart and the way that the candles pull and start each next candle from the center point of the previous, it can be a little bit smoother trend, and a way to kind of stay in a trade a little bit longer with the trail stop without getting chopped out from some smaller price action that doesn't mean a whole lot, is just noise, but on a candlestick chart, traditional candlestick chart might have got you taken out. So that's kind of what I'm looking at intraday, kind of my thought process. There's not a whole lot of hands-on action that in terms of micromanaging, just a matter of trailing my stop up to the target. So with that, I hope you have a great week, and we will talk to you soon.